Hello and welcome back to The Note, still in London this week. We have very important data out of China coming imminently. First quarter GDP data. Specifically, the leadership has now made it almost a formal target that they want to maintain growth at 7% per year. Could we dip below it, and what would the ramifications be for China and the rest of the world if we do? With me now to discuss this is an old friend of The Note. He's the associate at the China Centre in Oxford, George Magnus. George, thanks very much for joining me once again. Let's take a look at Chinese growth since Tiananmen Square and since Deng Xiaoping committed the leadership to stronger economic growth. What is the story of how has China managed to maintain growth so strong? Can it do so?
Well, I think there are two things that kind of jump out of this graph. The first is from around about the Asian crisis in 97, 98 until 2010, 2011. This was the kind of the long boom in which China opened up, joined the World Trade Organization, the rising tide of globalization and of economic reform, particularly of SOEs. Clearly, galvanized the Chinese economy.
But you're saying this is a one-off secular
But I'm just saying that this was a phase, a long phase, but not one that has proven capable of being extrapolated. And I think what we see here is really a trend towards a lower rate of growth, sustainable rate of growth over the medium term. So the government obviously wants it to be about 7%, which is the target, but I think it's kind of in transition to something that's appreciably lower, perhaps something in the region of 4 or 5% over the next few years.
Okay, now which could create issues given that the Chinese people have become accustomed to rather impressive growth. Now that raises the issue of what they might do to maintain growth at 7%. If we take a look at this chart that you suggested to us of real interest rates, they've been cutting interest rates, but price levels have been falling, with the result that it's not necessarily, as I understand it, as stimulative as you would think.
No, and what this chart shows is how the People's Bank of China, in a way, we would use the jargon, is behind the curve. So the vertical lines obviously show when interest rates have been cut. The red line shows the rise in real interest rates, so deflated by an average of consumer and producer prices. Producer prices have been falling for over 3 years. And so despite interest rate cuts, the real rate of borrowing actually has been rising continuously and still is. So, and it's extraordinarily high here at around 7%. So if growth comes in a little bit below 7%, and particularly if you look at the numbers quarter over quarter, it's very likely, as I think many people expect, that interest rates will be reduced, reserve requirements will come down again, and the People's Bank of China will say that they're just trying to offset what they regard as passive tightening because of deflation.
But I mean, a more cynical way of saying that is that they're deliberately pumping up asset price bubbles to keep the show on the road, aren't they? I mean, isn't that a very dangerous way to go about things, to keep cutting rates? And we've already seen what's happening in the Shanghai stock market in the last 6 or 9 months.
Yes, and of course they would never say that, but of course we know from our own experience, and it's no different in China, that actually if you create an environment in which people get acclimatized to declining interest rates, high levels of liquidity, strong central bank support for the economy, then asset prices do what asset prices do until they stop doing it. But for the time being, that certainly looks to be the way.
Okay, so finally, let's just talk about the risk that asset prices stop doing it. Is there a risk of a true hard landing, of a true economic crash, or perhaps more possibly of a true market crash coming out of this, or do they have the tools to avert that?
Well, I think there's a mixture of quite fevered speculation going on in the Chinese market, and also some confidence that the reform agenda and the rebalancing agenda actually will prove to be successful, and that President Xi Jinping has kind of struck gold, as it were, in terms of his economic strategy. I mean, both of these things have an element of truth, but I think in the end, actually, if it proves difficult to sustain high rates of economic growth and the investment downturn gathers momentum in real estate and elsewhere, which is seemingly the case, then I think that earnings disappointment and economic growth disappointment will get the better of this kind of fevered speculation.
Okay, George, thank you very much indeed. You've heard it here first. It will be a very interesting event indeed if GDP growth does dip below 7%. Keep your eyes peeled.